Alright, well this video is chapter 17, which is job costing. And so what we'll be doing here is, so in chapter 16 we went over mostly just terminology, what direct costs were, what period costs were, different kinds of inventory accounts. We had our direct materials, direct labor, work in process, finished goods. And so what chapter 17 is so now we kind of know what the costs are. Now we're going to figure out how do we apply those costs to the product that we're selling. And so there's two general costing systems. And so we're going to have a job cost, which is this chapter, and then there's process costing. And so job costing, you're going to use, it depends what kind of business you have on whether you use job costing or process costing. And so job costing is going to be used for something where you have a unique or custom product. And by unique, I mean like each individual unit is unique. Maybe you're a mechanic shop, and so every time that you do a job, so you fix a customer's car, that's very unique compared to the next guy who drives in. In one you might be doing an oil change, another one you might be replacing a transmission. So they're very, very unique and very specific. It could also be that maybe you're selling custom-made picnic tables. Maybe you're a roofer, and so you're going on, and each house that you do is going to be unique and separate. As opposed to process costing, where kind of the key with process costing is the units are indistinguishable from one another. So maybe you're making M&Ms, or you're processing gasoline or something like that. So it's hey, are you doing custom units, or is everything kind of blend together and is indistinguishable? So anyway, so this chapter we are going to focus on job costing. So let's go in here and open up the blank chapter 17 homework Excel file, and we're going to start with example 17-2. And so in 17-2, this is just kind of a quick, easy problem, and it just kind of looks at the relationship between these different costs and terms and totals. Because a lot of times in these problems, like, it's going to give you, hey, it'll give you the direct material, it'll give you the total manufacturing cost, it'll give you the overhead, and it'll tell you to figure out direct labor cost. And so this is just a little exercise to kind of understand how all these work together. So let's go ahead and jump in. And so the first one, part A, is asking us to figure out the cost of goods sold. And so it's giving us some information here from Kelman Company. That we just kind of plug this in, and we're basically just going to be backing into the numbers. So the first one is, using this information, how do we figure out the cost of goods sold? And so we know the cost of goods sold is sales minus cost of goods sold equals gross profit. So if we rearrange that, if we take sales minus gross profit, we'll get our cost of goods sold, which is how the formula here is set up. So all we have to do is plug in our sales, which is 3.6 million. And then it gives us our gross profit here. So we know what our gross profit is. Plug it in. Nice and easy. We have cost of goods sold of 2.95 million. Okay, the next is it asks us for our direct material cost. And so our for direct material cost, if we know our beginning and ending inventory and what was purchased, we'll know what was taken out, which is our actual cost. And so it doesn't give us a beginning balance for direct materials, so we just put in a 0 right there. And then if we add the materials purchased, which is over here, that's the 1,224. And then if we take out the indirect materials that we used, and then if we back out our ending inventory of 98,800, if I would plug in the correct number here, one extra zero, there we go. So now we have a direct material cost of 1,005,200. And then the last thing that it's going to ask us for is the direct labor cost. And so direct labor, we don't have a direct labor inventory account because it just goes directly into work in progress. But if we do know our direct material cost and we know our total manufacturing cost, then we can kind of back into that number. So the formula would be, if we know the total direct material cost, the total factory overhead, and the total direct labor cost, we'll know the total manufacturing. So if we just rearrange this formula to get it to where we're solving for the direct labor cost, we can figure this out. So we already have our direct material cost. We just have that linked to the cell above, and then we can plug in our total manufacturing cost, which is 2,640,000. And then if we take out the indirect labor cost, which is 216,000, and take out our indirect material cost of 120,000, and if we take out our other factory overhead cost, of 45,000, we will back into our direct labor cost of 1,253,800. So they just give us a bunch of information, and we just got to rearrange it to get the missing number. So not too bad at all. All right, so in the next problem, example 17-7, so it looks like we're given some weekly timesheets for direct labor hours from 3 of our direct labor employees. So we have their hours on a card here, and then down here we have what their hourly rate is. And so what it's going to ask us to do is asking us to journalize the entry for factory labor costs for the week. So to do that journal entry, first we have to do some calculations, because all we have is hours and rates here. And so we have this little table to kind of make it just a little bit easier. So we want to plug in their hourly rates in the first column. Then the second column is job 301. Plug in how many hours that they worked. Then we'll plug in the hours that they worked for job 302. And then the same for job 303. So what this does is the formula over here, we're just grabbing the total hours that they worked on the jobs, multiply it times the rate, is going to give us the direct labor cost. But it also says that they also put in time doing process improvement. And so process improvement isn't going to be directly related to the job. So we need to separate that out, because that's going to go to factory overhead. And so they did 2, 2, and 1. And so now we have the information to do our journal entry. So let's kind of work from the bottom up. So we have to pay these guys, and so what's the total that we need to pay them? We need to pay them for all the hours that they work. So we got to pay them for their direct labor hours and their indirect labor cost. And so that's going to be a total of 3,840. That's the sum of these two. Then we just need to split the direct labor hours and the indirect labor hours apart. So direct labor costs are going to go to work in process, and our indirect labor costs are going to go to our factory overhead. So then down below, it says that jobs that 301 and 302 were completed but not sold during the year, and job 303 remained incomplete at the end of the week. And so how would the direct labor cost for all three jobs be reflected in the financial statements? And so what that would do is if jobs 301 and 302 were completed, we would take it out of this work in process account and put it into finished goods. And then for the job that hasn't been completed, those labor hours would just stay in work in process until it was finished. So once it's finished, so the job that we did, we recorded it in work in process as it was earned, and as it's finished, it goes out of work in process into finished goods. All right, so next problem is example 17-10. Actually, before we move on, I did want to touch on one thing that tends to get just a little bit confusing, and that's with factory overhead. One of the mistakes that's really easy to make is, so we have this information over here where, hey, these guys are putting in hours for process improvement, which goes to factory overhead. And sometimes it's really easy to take those hours and to put them into work in process. And so how factory overhead works, it's very similar to direct materials with a little bit of a twist. And so the idea is, think of when you incur cost for factory overhead, that's like buying materials. So when you buy materials, you don't put it into work in process. You put it into direct materials. And so the same with factory overhead. Think of it as when you actually incur that cost. So you pay these hours, or you pay a utility bill, or you add depreciation. Those aren't going to go directly into work in process. The actual costs are going to go into factory overhead. And so that's what you do when factory overhead is incurred. Now there's a second step to that, where as we are working on goods, what we do is we use a predetermined factory overhead rate, and we apply factory overhead. And so what we're actually doing is we're taking a guess at what our factory overhead costs are going to be, and then we apply it to our product. And so when we apply it, it's coming out of factory overhead and into work in process. But when we actually pay the bills and really incur the cost, we're building that factory overhead account up, and we're debiting factory overhead. And so what's going to happen during the year is we're going to have all these debits to factory overhead from actually paying bills, and then we're going to have these credits to factory overhead as we're applying our estimates. And unless it's pure coincidence, those numbers aren't going to equal out, and there's going to be either a credit balance or a debit balance in factory overhead at the end of the period. And what we'll do then is we'll have to make an adjustment to true that up. Basically, we're making an adjustment because our estimate was just a little bit off. But we'll get into that a little bit later. But I just wanted to kind of touch on just kind of the nuance of factory overhead.